When you initially started investing, you most likely started with stocks. You may want to start diversifying and extending your portfolio now that you have a bit more experience. A diverse portfolio, as has long been established, is the best method to decrease risk while increasing profits. After all, diversifying your assets as an investor gives protection against market swings, which is becoming more important in today's society. Here are 6 approaches to entering the commodities trading industry. Investing in commodities may be a substantial method to diversify your portfolio beyond traditional securities, but as a new investor, there are various options to choose from, each with its own set of benefits and drawbacks. Hello everyone and welcome to Wealthy Wisdom. In this video, we're going to talk about trading commodities for beginners free, Beginner's Guide. If you're new to this channel, do like and subscribe to the channel. First, let's define commodities precisely. Commodities are any consistent resources recognized as basic items, such as the grains that go into your cereal in the morning, or the silver and copper contained in crude oil that is refined into the gasoline you use to power your automobile. Commodities have many forms, but they all share the qualities of being physical in nature and traded on global markets. Commodity prices often fluctuate as a result of changes in supply and demand. For example, when a crop has a big harvest, the price typically falls, yet when there is a drought, prices frequently rise due to anxiety that supply will be reduced. Metals are often offered in 4 fundamental categories: energy, livestock, and meat. Your selection of which category to invest in is mostly determined by your long-term goals, since each offers pros and cons. Commodity trading may be harmful if you don't know what you're doing. Learning the foundations of trading commodities for beginners will be much more beneficial in the long term. The first option is to invest directly in the commodity. If you want to engage in commodity trading by physically buying a commodity, your only option is to make a direct investment in one. One advantage is that you can avoid using a middleman. You might just look for a merchant who sells a certain product. When you no longer need it, that merchant will offer to acquire it from you. However, you will need to arrange for delivery and storage beforehand. Furthermore, if you're buying gold, the produce might be a bit simpler. It's easy to find a coin dealer who will sell you a bar or coin online. You may store it safely and sell it later if you like, but it becomes much more difficult to organize for the delivery and storage of bushels of grain or crude oil from cattle. As a result, the bulk of physical commodities are typically too time-consuming for individual investors to participate in. The second option is to invest in mutual and index funds. Mutual and index funds are ideal alternatives for beginner investors as a first step into commodities, since they work differently than other types of commodity investing. Although they are not traded on an exchange, these funds have the same liquidity as stocks. When investing in commodities mutual funds, you normally engage with a trained fund manager. Just keep in mind that managed funds often change greater fees. A managed account allows you to invest in a wide range of commodities and industries, enabling instant diversification. Index funds, on the other hand, track the price of a commodity throughout the trading day. Because mutual funds do not use an exchange, they do not monitor the price throughout the day. After the price is set, they wait until the end of the day to determine the value of the commodity. When you invest in these products, you benefit from skilled money management, enhanced diversification, and liquidity. Investing in mutual index funds is a great way for investors to gain from firms that deal with commodities without directly owning stocks. The third option uses commodity pools for commodities. These people will pool money from multiple investors and invest it in a commodity or commodity basket. Account statements and annual financial reports will be sent to all participants. Your CPO will keep track of who is investing, what they are investing in, and any transactions affecting the pool in addition to administering your money. They might also base their investment decisions on market movements. For example, they may help you keep track of commodity prices and choose the best ones for your portfolio. When you work with a CPO, you have more investing options. Because they manage a group of investors, they may make better bets with the pooled money, which offers up more alternatives for commodities trading. If you like this video, don't forget to like and subscribe to the channel. Let's continue to discuss trading commodities for beginners. The fourth option is to invest in commodity stocks. You may indirectly invest in commodities by acquiring shares in companies that manufacture commodities. You might, for example, invest in mining stocks, oil stocks, or agricultural stocks by investing in British Petroleum. You may enter the oil sector, and by investing in Rio Tinto, you can enter the metals industry. Unlike the fundamental real value of commodities, the risks associated with commodity stocks often center on the corporations themselves, whose prices may be negatively influenced by business operations or other company-related difficulties. This means that a company that manufactures a commodity will not necessarily rise or fall in parallel with the product it manufactures. An oil production firm will benefit from increasing crude oil prices and lose money from dropping ones, but what counts more is how much oil the company has in reserve and whether or not it has lucrative supply agreements with clients that have a high demand for oil. Although there is no way to completely prevent this risk, investors may extensively research the firm before purchasing equity. Fifth option, invest in future contracts. For novices, a futures contract offers an extra entry point into trading commodities for beginners. A futures contract is an official contract to buy or sell a certain commodity at a specified price in the future. Futures contracts need substantial market research to get started, which discourages inexperienced investors from doing so. The primary reason for this is that speculative activity predominates in futures investing. Investors, on the other hand, have the option of dealing with a broker or selecting contracts with a buy option. Traders use futures contracts to speculate on the direction of commodity prices. You would buy futures if you thought the price would rise and sell futures if you thought the price would fall. In general, you're committing to buying X amount of a certain product at a future date. For example, you may promise to buy 10 tons of coffee 30 days after the contract is done. You anticipate that by that time, prices will have moved enough to enable you to profit. One significant risk is that the margin requirements for trading commodities are far lower than those for stocks. Margin trading entails borrowing money, which might compound your losses. Because commodity prices are volatile, you must be prepared to satisfy any margin calls, which occur when your broker asks for a higher deposit. Some of the most well-known futures markets include the S&P 500 Index, the Dow Jones Industrial Average, the Nikkei 225, the FTSE 100 Index, and the DAX Performance Index. The sixth option is to invest in commodity exchange-traded funds or ETFs. If you have an excellent understanding of stock trading but limited finances for investment, you could look into commodities via ETFs. ETFs or exchange-traded funds allow you to trade commodities in a way similar to stock and share trading. They, like stocks, may be bought and sold, and their prices change during the trading day. Investors who wish to acquire commodities ETFs might get help from an online or traditional broker. ETFs are a great way for consumers who are interested in changing commodity prices to potentially profit from changes in commodity prices without directly investing in futures contracts. Trading ETFs is also a great way to obtain exposure to the commodities market with low risk, since you may hold your ETF shares for as long as you like and they don't expire after a certain period of time. Before you invest, be aware of some of the costs associated with trading ETFs, or just ask your broker whether they provide demo ETF trading. Gentlemen, here are the 6 techniques to trading commodities for beginners. Commodities are seen as risky investment prospects because of the possibility of unpredictability, such as unusual weather patterns, illnesses, and natural and man-made tragedies that are difficult or impossible to foresee. Commodities are best suited to investors with a large amount of capital to spare and at least some knowledge. Including commodities in a varied portfolio rather than putting all your eggs in one basket is the best approach to limit risk. If they wish to invest in a commodity for the long term, most individuals would be better served by commodities, equities, mutual funds, or exchange-traded funds or ETFs. We've reached the end of another video and thank you for watching. I hope you have learned trading commodities for beginners. If you like this video, do give us a like, subscribe to the channel, and comment down below. Thank you and goodbye.